Imagine a group of powerful investors who have billions of dollars at their fingertips. They don't just invest in the market, sometimes they can actually move it. These are hedge funds. Now the question is, how do hedge funds influence or even control the market? First, let's understand one simple thing. Hedge funds manage massive amounts of money. When you have that level of capital, even a single decision, buying or selling, can impact stock prices. If a hedge fund starts buying a particular stock in huge quantities, demand suddenly increases. And when demand increases, the price goes up. Other investors see this movement and start buying too, creating a chain reaction. But it doesn't stop there. Hedge funds also use advanced strategies that most retail investors don't use. One of the most powerful tools is short selling. This means they bet that a stock's price will go down. If multiple hedge funds start shorting the same stock, it creates downward pressure. Panic spreads among small investors, and many of them start selling, which pushes the price even lower. Another way hedge funds influence the market is through information advantage. They have access to top analysts, research teams, and sometimes even insider-level insights about industries and companies. This allows them to act before the general public even realizes what's happening. By the time retail investors react, hedge funds have already taken their position. Now, let's talk about leverage. Hedge funds often borrow money to increase their position size. This is called leverage. With leverage, a hedge fund can control positions much larger than their actual capital. This amplifies their influence on the market. A leveraged bet can push prices up or down much faster than normal. There's also something called coordinated movement. Sometimes multiple hedge funds or institutional investors follow similar strategies or signals. When they all act in the same direction, buying or selling, it creates massive momentum in the market. This can lead to sharp rallies or sudden crashes. And then comes market sentiment. Hedge funds don't just react to the market, they help shape the narrative. When big funds publicly disclose their positions, or when news spreads about their investments, it influences how people think. If a well-known hedge fund invests in a company, many investors take it as a signal and follow. This increases the stock price even more. But here's the twist. Hedge funds don't control the market in a literal sense, they influence it. The market is still driven by millions of participants. However, because of their size, speed, and strategy, hedge funds often act as market movers. A great example of this was the GameStop situation. Some hedge funds heavily shorted the stock, expecting it to fall. But when retail investors collectively started buying, it created a short squeeze. Hedge funds were forced to buy back shares at higher prices, leading to massive losses. This shows that while hedge funds are powerful, they are not unbeatable. So what should you learn from this? The market is not just about numbers, it's about power, psychology, and strategy. Hedge funds use capital, data, and timing to influence movements. But as a retail investor, your strength lies in patience, discipline, and understanding the bigger picture. Because at the end of the day, markets move not just because of money, but because of human behavior.